Hello and welcome. Now, markets are hitting new highs, quality is expensive, and small caps, they are resetting. Value also, that's being redefined. So, to help us make sense of all of this and to understand where genuine value still exists, we're joined by Venugopal Manghat, he's CIO, HSBC Mutual Fund. Mr. Manghat, welcome. Good to have you back with us.
Thank you. Thank you very much for calling me.
Right. Now, with markets at all-time highs and some pockets looking pricey, where do you still find valuation comfort today, and which areas make you cautious?
Yes, I think post the 3 or 4 years of strong performance from the markets post COVID, by September 24, I think valuations had moved up and ownership levels had also gone up quite significantly. But more than that, I think you have to look at valuations in conjunction with earnings growth and ROE expansion. So earnings growth was weak. Since September 24, we've seen the growth slow down, both at a economy level and for corporates as well, which then resulted in optically the valuations looking even more expensive. So I think that's been the cause of worry. We've seen a time correction play out. In pockets, I still think the valuations are reasonable. For example, in the financial services space, let's say banks and NBFCs, I think valuations are reasonable. Even when you look at IT and the tech sector, on a 5-year relative valuation basis, we see valuations at a reasonable level. Though I think again growth has slowed down there, so one needs to be careful. Not just think about this as a great opportunity. But that's again an area where relative valuations are slightly lower than what we've seen in the recent past. Also, I think within this market, there are a lot of stocks which have corrected very significantly in the last 1 year, post September 24. The indices have remained kind of flat to maybe marginally negative. But I think if you go down into and outside the index, you see a lot of stocks seeing the pain and having corrected quite significantly. So it's a bottom-up market. I think leadership is not there at the moment, and therefore one has to look for ideas, where correction has already taken place and valuations have become reasonable, and where earnings growth is maybe coming back to a normalcy.
Okay, cool. Now, sir, your style is rooted in owning the high quality business at the reasonable price valuations. How do you stay disciplined when the quality stays expensive for the long stretches?
Yeah, I mean, it is tough in an environment like this where yeah, good. So let me explain our approach. I think we like good quality businesses. You're right. Good quality businesses mean the ones which are well managed and which have a long runway of growth ahead of them, and where companies or businesses have moats and some competitive advantage, less prone to disruptions either from technology or from other external environment. Those are typically businesses we like and run by good quality people. Those are the businesses we like. In the current period, I think towards the end of this, the last strong market rally that we saw till September 24, at least, we saw a lot of these companies reaching fair to high valuations, and it is tough to really keep your faith in these companies and remain invested. But that's what you need to do. I mean, you'll have to be a little disciplined, stay away from putting fresh money into companies at very high valuations, not chase these at any price. Our basic approach again is, or philosophy has been, to buy companies with based on growth at reasonable price. So we tend to, or we try not to overpay for what we buy, and so incremental money is not chasing any of these. Some of them, where we had invested in the past, and which have done very well, and we think that the longer term story is intact, and yeah, earnings growth still continues. There we remain patiently invested. Maybe just tinker with the overall exposure in the portfolio, within the portfolio, but we remain invested in these companies. But we don't, we try not to chase companies at higher prices and not to overpay for what we buy.
So, across the funds that you manage, sir, if you could elaborate on the core principles, the non negotiables that guide your stock selection, and how have these investment disciplines evolved with changing market cycles?
Yeah, so I think our basic tenets of investing remain the same. We are long-term investors. We invest based on fundamentals. When I say long-term, we generally have lesser churn of our portfolios. We remain invested patiently for longer periods of time and let businesses compound over a period unless valuations become too expensive and or there are structural changes, on the business which force us to reduce our positions or exit. Otherwise, we remain patiently invested in companies. We are active investors, so we don't really shy away from taking positions outside the index. We, in fact, encourage fund managers to really look outside the broad market and look for opportunities for generating alpha. Our strong belief is that that's the only way one can generate alpha and create wealth over a longer period of time. And therefore, we don't really, though we are benchmark-aware investors, we never go very close to the benchmark, and we don't have a philosophy of being plus or minus certain basis points or percentage from the benchmark. We don't follow that kind of a philosophy. We are bottom up in our approach to investing, so every company comes into the portfolio based on its own merit. The top down is used only in cases where, for example, a large cap portfolio or a thematic like an infrastructure fund, you need to have, or a business cycles fund, you need to have a top down view on what sectors are doing well, and then decide the stocks that you should have in the portfolio. Even there, the stock selection comes based on bottom up evaluation of these companies and businesses. And so those tenets remain the same. And we are, true to label investors, which is, you could say one reason why, some portfolios have not done as well as peers during this last 1 year, because we have stuck to our mandate. We believe strongly that the investors give us this mandate to manage money, based on the objective that we have set out for each scheme, and we have to maintain that all throughout. And so we are true to label investors, whether it is infrastructure, whether it is small cap, whether it is value, whether it is any of the other funds that we run. So those tenets remain the same, and that's the reason why we've been able to over a longer period of time remain in a fairly good position.
Now, coming, sir, to a few of the specific fund related questions. Sir, with an alpha of around 7% in the last 3 years for the HSBC Value Fund, which has delivered meaningfully higher returns compared to most of the peers. But however, there is relatively higher volatility in the fund also. So could you talk us through how do you think about this risk return trade-off in your stock selection and portfolio constructions, and whether this is an outcome of where you're finding the value today?
Yeah, I mean, so the value definition that we have is very different probably from what peers have. There are multiple ways of looking at value, and it's kind of loosely defined. We have stuck to our definition all throughout the last so many years that I've been managing this fund. This is, for all practical purposes, a multi-cap or a flexi-cap kind of portfolio. It's a very diversified portfolio, no market cap orientation, can move from large to mid to small and vice versa. It acts like a flexi cap fund for all practical purposes. The last 2 or 3 years, we've had a good run in small caps and mid and small caps rather, and we've had a fairly good position in these. We've also had, though sectoral exposures don't make a has to be on a bottom up basis identified as value. If you add up the overall numbers, some sectors stand out. During the last 3 years, maybe industrials and manufacturing would have been one of the higher, positions in within the fund. And in the last 1 year post September 24, we've seen the volatility in some of these sectors really being higher. Volatility in small caps being higher, profit booking, happening across multiple sectors and stocks, and a flight towards the larger cap names and in the market itself. So that would have probably resulted in the last 1 year being a little skewed, looking a little different from the past few years. But these years you get in between, you have to live through that, and we invest for the longer term, and so we're really not too much worried. And I think the alpha generation and the performance will come back eventually with markets changing color.
Sir, if you look at the portfolio, then since last 2020, since the late 2023, the fund has consistently kept the small cap and mid cap exposure to around 50-55%. What's driving this stance, as you explained, but will you continue to hold such large amount in the small and mid cap segment?
Yes, I think, yeah, and I've stated this in the past as well, that we are very positive on the mid and small cap part of the market, especially the small cap part of the market. I believe that this is the true reflection of a growing India and a developing India. If you dissect the market into two parts, you will see that on one side you have the banks and the IT companies and the consumer staples businesses, which are largely large cap, and you can add telecom and oil and gas to that. Those are large businesses. They've matured over a period of time. Though these parts of that still continue to grow at a reasonable pace. So for example, banks still continue to grow, but those are mature businesses. They've become large cap over the last 20-30 years. What is on the other side is actually manufacturing, consumer discretionary, and a host of other sectors, sunrise sectors, which are now getting listed. And so that part is largely mid and small cap in nature. They are much smaller companies. If you look at, for example, within consumer discretionary, multiple sectors are still very small in size as a overall pool, for when you look at it as a sector serving, let's say, 140 crore people. It really looks very small for that requirement. And over a period of the next 10 years, let's say, many of these sectors will grow significantly. And therefore, my belief is that the big opportunity to create wealth and generate alpha, remains in the broader market, in the smaller cap names, where if you identify the right companies, the right businesses run by good people and stay invested for a longer period of time, you can generate significant wealth. That's the opportunity in India, and one should not miss that, is what we believe. So, to answer your question, in most of our funds, we will continue to be invested in mid and small caps. We will continue to try and identify companies. That's our endeavor. That will continue to identify companies in the broad market. And as I earlier mentioned, our churn ratios are generally lower than competition over a period of time. And some years could be higher. For example, the last 12 months is slightly on the higher side, given that markets have also changed. Leadership is changing. So, generally speaking, yes, we are positive on the small caps, and we think the environment is again turning conducive for the small and mid caps.
Sir, since you are overweight on the small mid cap segment even going forward, so how do you balance the valuation gap between the small cap, mid cap, and the large cap given the current market scenario? How do you look at it?
Yeah, so I mean, there are times when there's a catch up. So this is a kind of cycle that takes place, and for 3 years, small and mid caps really did very well, and valuations had moved up, and large caps were lagging. Now, for some period of time, you have large caps doing better than small caps, and a catch up happening. That period actually coincided with the lower growth environment, the risk off and currency volatility, FI selling, and all of that which took place. So now, you are again getting back into a situation where growth is stronger, earnings growth is catching up. The environment is still very conducive. Liquidity is strong. Inflation, interest rates are lower. All of that is actually good news for the smaller companies in the market. So, for example, in the value fund that you spoke about earlier, more than 40% still remains in large caps. We still have banks and some of the other sectors where large cap is dominant. But at the same time, we continue to balance the portfolio with mid and small caps to try and get that alpha over a longer period of time. So that's the endeavor. We try and balance portfolios wherever possible. Obviously, in a small cap fund, you have to focus more on small caps. And however, we've remained true to label there as well. We haven't played large caps there. We played only small caps and mid caps, predominantly small caps in that portfolio. So for us, the mandate is important. For us, the our conviction is important, and we uh, put money where we think the longer term performance can deliver.
Okay. Now, sir, the multi-cap fund has outperformed the BSE 500 by remarkable 9% annualized since inception. So, what are the key drivers of stock selections, sector selection, or any other reasons for this outperformance?
Yeah, I think when you look at the attribution over the last 3 years or so, it's completing 3 years in January 26, and I think a significant part of the positive alpha is coming from stock selection, and individual stocks that have contributed meaningfully to the performance and alpha generation. Some sectors have also done well, within those industrials, financials, individual stocks within these sectors have contributed quite well. Yeah, and this is in line with our overall, one, the macro framework or the themes that we like. One is investments, the second is consumption, third is financialization, fourth is digitization. So these themes are dominant in most of our portfolios. And then bottom up approach to identify companies in each of these themes. I think that's what has helped the fund outperform in this period. But it's if you look at the attribution specifically, it is more stock selection than allocation.
Right. So, but the fund, it began with a relatively higher small cap exposure at a time when the segment was heating up, and yet you pivoted early, cutting small caps and moving into large caps as the correction set in during late 2024. So many peers, they struggled with this timing. What gave you the conviction to de-risk when you did, and how do you weigh macro indicators against bottom-up insights during such inflection points?
Yeah, so I mean, the answers there in your question. I think once you read the macros and try and figure out what's happening, to the overall economy, and within that, to different sectors, you get a sense of whether higher growth and higher alpha is possible from the same investments that you've had, or you need to change your positioning. Also, I think valuations is again an indication, whether you should really book some profits and move into names which are more attractive, or at least de-risks the portfolio in that sense. Multiple reasons why we did that. I think large caps were looking a little more promising in terms of relative valuations, though I've always maintained, even during this last 1 year, that we like small caps over large caps for a longer term period. Given that growth was slowing down last year, and that valuations had moved up, and large caps or were relatively less expensive, we decided to increase our exposure there. Of course, we had a lower exposure to banking prior to that. That also resulted in a higher large cap exposure. You could say that that was not maybe by design, but it happened because we were underexposed to banking, and we found that valuations were reasonable there, relatively cheaper, and and the situation was getting better. So that again led to the large cap exposure being higher. So we constantly revisit the portfolio to see if we need to change our stance in any way. So it's just a natural progression of that.
Right. So there's currently about 50% overlap between the portfolios of multi-cap and the value fund. So how do you differentiate between these two strategies? And is this level of overlap something that you're comfortable with from an investor's point of view?
Yeah, I mean, overlap happens, maybe because I'm managing both the funds. So, some of the ideas, but, we go by the objective of the scheme, as I earlier mentioned in the mandate that we have. Sometimes you have, stocks which will fit into value, but can be a good opportunity or an option in the multi-cap fund as well. And we, as you know, we need to maintain a 25% exposure to large, mid, and small caps at all points in time in the multi-cap. So when you have a value opportunity, why would you want to miss it in even in the multi-cap fund within small caps, for example? And if it is a value opportunity in small caps, you would also want to play it in small caps. So there will be some overlap like that between some of these funds that the same fund manager manages, but that's inevitable. But I don't see any issues with that. I think that will continue in future as well.
Now, sir, even with the deep correction in the IT sector, you haven't taken a contrarian call in the sector. What makes IT unattractive for you right now?
Growth rates that we've seen in the IT sector in the past were significantly higher. Now we are seeing low single-digit growth rates. I don't think that's going to change in a hurry. We also have this wave of AI investments going on. At the moment, we don't know how this is going to play out and what the impact of this would be on different sectors and even within the IT sector on different companies. I think it's too early to call this a value play. In any case, I think valuations, though, if you take the last 5 years, valuations may look reasonable. But if you take a longer term history, I think valuations are not very cheap even today. So in that sense, I don't see, this, qualifying significantly as a value play. Of course, as a contra bet or as, on a relative basis within this market, which has already which where many other sectors have become expensive. Maybe you could do a sector rotation trade, but beyond that, I don't think we are looking at this as a structural positive trade.
Right, coming to the small cap fund, it has been in the third and fourth quartiles over the 1 and 3 year period. So what weighed on the performance and how are you planning the revival, sir?
So in a bad year, where the index has given, let's say, September 24 to September 25, we've seen, I think, -8% or -9% or some thing like that in terms of returns. That's a bad year, I would say, after 3 years or 3 or 4 years of very strong performance. In a year like that, where the index itself is negative, you don't really have too many options. You don't have I mean, you can't really do too much in such a market condition. I think it was a tough market the last 1 year. Stocks were down much more than the index, and which contributed to the overall fund performance also being lower for the last year. We have, like I earlier mentioned, we've been true to label investors. We don't play large caps within the small cap fund. We've never bought large caps in the portfolio. Some stocks have moved up into large caps. We've cut down those exposures over time. And if you don't have large caps in this last 1 year, where many of the peers would have, let's say, 5 to 10% exposure in large caps, that would have saved you maybe a few hundred basis points, and which changes the quartile very easily. So multiple to reasons, and I mean, we have stuck to our mandate, and we've some sectors have also contributed, I would say. I mean, look at the allocation to, like, for example, industrials, capital goods, real estate, even materials, building materials, for example. A lot of those sectors have not really, given us returns in this last 1 year, and have contributed to as a drag to the overall performance. We have kind of restructured the portfolio to some extent, and that's an ongoing process as well. We are, moving slightly more into consumer discretionary names, so we don't want to really move in too fast and be very early. But we're looking at individual stocks on a bottom-up basis to see where we can add exposures. A lot of new stocks have come into the portfolio. Some stocks have gone out, which is why I earlier said that last few months you would have seen the churn of the portfolio being slightly higher, but that's only because we are restructuring the portfolio and the markets have changed in terms of overall color and leadership. So some changes we are bringing in to the portfolio. I think the market scenario is improving, and we're expecting some positive results from this over the next 12 months.
Now, sir, the portfolio holds around 100 stocks which helped during the broad release but challenge performance during the narrow markets. Are you consciously moving towards a higher conviction, or does the wide diversification remains the central to your process in this particular fund?
Yeah, we continue with our diversified portfolios. We have a longer tail in most of our funds, and the small cap fund, we have definitely more stocks in that portfolio. The number of stocks also coming from the fact that the size of the fund is larger, and being a small cap fund, you have to consider the risks, and especially from a liquidity point of view. And therefore, some stocks which are smaller market cap, you cannot have very large exposures, and given the low floating stock and the low volumes that get traded in a day. So we are cognizant of all the risks. We consider these and then build positions. So the diversification will remain as a theme within this portfolio. But apart from this, I think, I mean, as I earlier mentioned, the true reflection of a growing India is actually the small cap part, and you have multiple sectors and stocks that are doing well, or are likely to do well over the next so many years, and therefore it is important to create a basket of stocks within in the portfolio at this point in time, and then as conviction builds, as the numbers come, you start increasing the exposures there, and during those phases the volumes and the liquidity also improve. So we'll get into that phase, but at the moment it continues to be a diversified portfolio with a long tail.
Right. So right now, which parts of the market look most crowded, and where do you think expectations seem well ahead of fundamentals?
I think there are parts of the market that look slightly more expensive, but I think you are seeing a lot of sector rotation at this point in time. So for some period of time, one sector would move up and become expensive and then fall down, and then another sector will take up that role. So that's what's happening. So it's not right to say that these sectors are looking expensive and these are not. I mean, on an overall basis, I think banks, financials, as I already mentioned, on a relative basis, the last 5-year period, if you look at the valuations, IT could be one where it is cheaper. But on the overcrowded and expensive side, I think most of the IPOs today are coming at expensive valuations. The sunrise sectors, those are really the ones where the enthusiasm is very high, and there is overvaluation that I see. I think that's the risk to this market, and sectors and stocks that one needs to be careful.
So cyclical sectors and industrials and materials can often turn into value traps. What guardrails help you distinguish between temporary dislocation from the structural challenges?
Yeah, I think it's important to understand the cycles when you get into the cyclical sectors and stocks. You have to understand businesses and how the cycles behave for these businesses, where exactly these businesses are at this point in time, and then therefore give or put exposures or take exposures within the portfolio. So understanding the cycle is extremely important, and understanding where the business is at this point in time is important. Again, for cyclical businesses, you can't just sleep at the wheel and let it go for a longer period of time. You will have to keep revisiting the model. You'll have to keep revisiting the variables to see if there are any indications of a peaking out, or overheating that can take place. I think one has to look for signals like, margin pressures, for example, or, most importantly, working capital conditions, cash flows. One has to keep a watch on those, to see if there is any deterioration. ROE expansion is another, you need to watch that as well. Then you could also look at capital allocation from companies. A large number of companies do mergers and acquisitions. They overinvest. They do significantly larger capex, extrapolating the demand, for their businesses, or for their products. So I think a lot of these things have to be kept in mind while you invest in cyclical businesses, and of course, valuations also are important.
HSBC AMC, it offers a few distinctive international strategies, such as the Brazil Fund and the Asia Pacific Dividend Yield Fund, so which have been running for many years. So, could you please help investors understand the rationale behind these offerings and what differentiated these opportunities? And what is it that they provide that Indian investors typically can't access through domestic markets, domestic funds?
Yeah, I mean, I think, these are fund of fund structures. So we invest in funds outside India, and this is offered as an addition to the bouquet of products that we have on the domestic side. So if investors have, or want the need to diversify, outside India, create a portfolio which has an exposure outside India, these funds are helpful there, and therefore add to the bouquet. So that's the only idea behind this. So it's not just the Indian market, but provides the opportunity to invest outside as well. I continue to believe that India offers the best opportunity for investors in the longer run, because as you know, India is the fastest growing economy, with this size of population, the age of population, the demographics, the strong focus on manufacturing and investments from the government side, the strong balance sheet at this point in time, or at a macro level. All of that means that India is a great place for investors to invest and remain invested. But if somebody wants to diversify outside that, to hedge their portfolios, to take advantages of some other bets, like for example the emerging markets outside India, I mean, these are opportunities that we provide to them as well.
Okay, okay. Sir, finally, you manage four funds at the HSBC. If you were to briefly define the ideal investor profile for each, how would you describe them? And more broadly, what does the HSBC offer through the fund management approach that gives investors confidence that they are getting something distinct and hard to replicate elsewhere?
So all the four funds that I manage have different characteristics. The multi-cap fund has very disciplined approach with a minimum 25% in large, mid, and small caps at any point in time. But if you extend that to value as well, value is again a kind of flexi cap portfolio where there is no specified number in terms of large, mid, and small cap exposures. Can be much lower or higher depending on where opportunities are. But that's also a diversified portfolio. So those are two diversified portfolios. Then small cap is more, the small and mid caps, largely small caps. About 70% of portfolio is small cap, and about roughly 30% or 28% is in mid caps. We don't invest in large caps there. So that's the positioning of the small cap fund. The volatility is higher in a small cap category. And that's what we've seen in the past. The fourth is the infrastructure fund that I manage, where this is a thematic. It's focused on infrastructure. Again, we are true to label, so we don't have banks or financials in this fund, other than maybe some power finance companies or infrastructure finance providers. But again, we don't have healthcare in this portfolio. We don't have automobiles. Some of that is part of the index. So this is a differentiated portfolio. It's a purely infrastructure-oriented portfolio. We believe that investments and capex related theme is one of the key themes that is driving the India story and the growth for the economy. And therefore, this is something that we continue to like for the longer term.
Right. Well, with that, it's time for us to wrap up this conversation. Thank you, Mr. Manghat, for joining in and sharing your insights. Truly appreciate your time.
Thank you very much.
Thank you, sir. Thank you.